All right. Good morning. Good morning, everybody. We have a lot of, I like to use the phrase soft data, a lot of soft data today, economic data, inflation data, and we have some Fed speakers as well today, both in the US and in Europe. We made it through another night without Japan wrecking the whole system, but as we'll see in the charts in a little bit, there was some anticipation of chaos, which didn't really come through. I don't think that's a bad thing, right? It's almost like going to the racetrack, not to watch a race, but to look for a big wreck, right? Which I don't watch sports, but from what I hear, watching the races is all about waiting for the wreck. We're still in a holding pattern, which I've heard it said now more than once that 2023 may be the year of sideways. Of course, sideways still has a range up and down. So, there could be bursts that take us to the upside and cliffs that drop us back down again. But more and more economists and analysts are calling for a year that we really just sort of stabilize and we quit really legging down into newer lows in the S&P, but we also don't revisit, the highs. So, that's going to greatly change how our options are traded. It's something to really consider. Probably going to need a whole new set of educational videos on, ways to use options effectively in that kind of marketplace. The nerd in me is all excited about that. Yeah. All right. So home builder, we've got Beige Book. We've got a couple of different Fed speakers, some of them more dovish than others, but for the most part, they're going to continue to sing from the same hymn book. We're not really expecting any of them to, get out of line. Microsoft is laying off more workers, and so is Amazon. In the last few weeks, we've seen that become a catalyst for upside moves, right? The market likes to see that these companies are actively engaged in trying to reduce costs. And of course, cutting your workforce is one of the fastest ways to do that. Not necessarily the best way, but it's the fastest. That's the third one for Microsoft. I've lost count on how many that is for Amazon. Apple has news this morning on a product line, coming out with one product and then delaying another one. Shouldn't be overly impactful on Apple's stock. The main thing is going to be that today's a bad day for a 0 day. And that doesn't mean that you can't do one, especially if we pick a side and just run hard, but it hasn't been that kind of market lately anyways. And with econ on deck literally all day long, there's no safe spot to put on like an out of the money spread and hope that you can get far enough away. If you do it, near the money or at the money, the way that I like doing those, at least if you're wrong, you can cut that sucker fast, right? But when you're really far out of the money, the thing turns negative as soon as you put the trade on. And since price hasn't broke your strikes, you don't quite know if you should cut it loose or not. And then by the time you figure out that you're wrong and you need to get rid of it, the losses are usually pretty rough. So if you're going to do 0 days today, maybe consider getting a lot closer to the money or doing something like butterflies. And I know we buy butterflies, which kind of goes against the grain because we always talk about selling 0 day trades. But butterfly is kind of an exception to the rule, especially if you get into broken wing flies or ratio adjusted flies. There's so many ways to get the job done, right? So just something to consider. We could get an outsized move at any time today between 9:30 and 10 econ, and then 2 o'clock and 3:15 econ. So you really don't have a window where you couldn't get an outsized move that runs you over. So just be cautious if you like doing those far out of the money 0 day trades. Or use the SPX and build the trade in the money, credit spread style, where you're risking 10 cents if you're wrong. And I mean that's the only other way to go, right? Then if it does make a big move, you're going to get paid. Oh yeah, I like it. You like it. I guess before I get off this page, just take a look at it. The range that I've heard talked about, and it's going to seem a little wide. And of course, we would want to always narrow it down as much as we can. But the range is 44 down to basically 35. Just for easy numbers, calling it 34 would be more appropriate because, we're very likely to overshoot a little bit if we were to retest the lows. So it's 1,000-point range from 44 to 34. And of course, we can tighten that up, looking at it on quarterly basis, monthly basis, weekly. Those charts are just so valuable. There's a reason that institutions lean on the monthly and the weekly charts way more than they do the daily stuff, right? And of course, we can't lump them into a box and say, well, they or all of them do it this way, because no, they are as diverse as we are. The long and the short of it right there. If we spend most of the year chopping through this zone, we'll have to redefine our systems. All right, volume is still, again, light. I would have anticipated that it picked up a little bit at this point, but this very well could be what we get for the week. It's been a very tricky market in the last few days with sharp, hard, immediate reversals randomly in the middle of nowhere with lots of flow behind it, pushing a market 5 or 10, even 20 minutes, and then it just drops back out again and flips back over. So if you're struggling to day trade in the current market, just understand it's probably not you, right? I know a lot of new traders think that if they just knew more, they would be better off. And of course, I can't argue against the idea that the more you know, the more informed you are, the better you're going to do. But on the other side of that, trading in good conditions is always preferable, right? I think we would all rather trade in this than trade in that. I call it consistent, persistent market message. When everybody out there is buying, when everybody out there is selling, it's easy to see, and it's a heck of a lot easier to sustain a move. So I think this kind of light volume is going to stay with us for the rest of the week. We had a really narrow IB last night, which kind of went against the grain momentarily, and we haven't been back down there yet. So we're going to be looking this morning to retest this Globex high at 40.30. If we don't get it done in the Globex, then we're going to be looking for it as we come into the open. Just keep in mind, just like yesterday when we overshot, right? Friday's high or Sunday's high was the rejection point, but there was just so much pressure behind it that we overshot it first before rolling over. With the lower volume, these kind of moves are more prevalent, right? They happen more frequently in lower volume. So if we do go to retest the highs, keep in mind liquidity exists on the other side of the pivot, right? If we get to yesterday's high or even this Globex high, liquidity is on the other side. So we don't want to just hit it and drop. We want to hit it, break through it, get into that liquidity, and then drop. $40.11 is the cog line. We have the daily pivot point that we've crossed through multiple times already this morning. It has no value to us at this point. We're still maintaining above the weekly pivot point, which is down here. And we're just really holding steady above it. Solid as a rock. Remember, the more that we hold compressed like this, the longer we stay compressed, the more energy this market is building up, and the more orders that are being filled with stops on either side. All right. So if you think about that liquidity that I was just talking about, longs and shorts are positioning here, just building up more and more and more and more positions. And their stops are outside the range. So we call this a draw, just like it sounds, just drawing everybody in. And what we very often see is we will raid first into the liquidity and then make a move. Right. So the strat talks about the megaphone pattern, where we start expanding a little off the top and then off the bottom, and then we expand a little more off the top and a little more off the bottom, and it starts to form this megaphone shape before it finally breaks and runs. That's different than a raid and a draw, because with a raid and a draw, it's a one shot, right? It'll break through one time, gather up a bunch of liquidity, and then face plant, run the other direction. We did have a rising wedge trade yesterday. So, the overshoot reversal and the wedge were the two plays yesterday. Other than that, I didn't really have a lot of opportunities. Not directionally anyways. So that's what we're going to be looking for this morning, 40.35 with a potential overshoot. I'd be surprised if we actually get all the way up into it. ADR is still really light, really low. It's at 1.6 at this point, which is below a $70 expected move. There's no market maker move on deck. our $70 expected move comes from an average daily range over a 1 month time period. It's a 20-day ADR. It's looking back over the last 20 days and asking what has been the highest point and the lowest point on average. How far have we moved in a single day on average? And that's been kind of fading off, but it's about 70 points a day. If you look at the implied volatility expected move, it's 1/3 of that, right? It's like 25 and we're looking at 75. So volatility still is not representing our risk appropriately. Kind of goes to our benefit when it comes to options. We're still looking for a catalyst, looking for an excuse, right? Like it's a turn of phrase, but this range is narrowing. So we're building up. We're not only compressed in a range and winding up sideways, but it's getting narrower and the compression is getting tighter. So the move is coming. And it's something to really consider because these are the opportunities for those really far out of the money debit spreads, that really cheap stuff. Now, don't get me wrong. I don't want a whole portfolio just full of YOLO lottery ticket junk, right? I wouldn't want to have a whole port full of that. But there's times like this when we're winding up for a big move. You can see the big move coming, even if we don't exactly know what direction it's going to go. The out of the money debit spread is so cheap, it doesn't matter. Put both of them on, right? Who cares? You're talking like 15, 20 cents. And hey, I don't want to lose. I don't like to lose, but I'm not going to lose sleep over 20 cents, right? Put the trade on, really widen it out. Put it on both sides, let it run. If it doesn't work, you're going to lose your 20 cents. But if you hit it, you know, you're going to make $6 or $7 on that 20-cent risk. That's one hell of a return. I use the ES in the mornings because it's open, right? Looking at the SPX wouldn't do us much good. But obviously, when we're talking options, you're better off using SPX and SPY, not using the futures options. Although the ES is liquid enough in its options market that you can trade it, but the MES, not as much, right? And with the NASDAQ, no, the NASDAQ futures options are not liquid enough. So for this, you could do it day to day. You could do it week to week. I would say step out a little bit. Obviously, the farther out in time you go, the more the trade is going to cost you. January 24 has got a low vol, and Jan 23 is even lower. These prices are a little wide, but you know, when it comes to the SPX, that's not uncommon. Liquidity is a little rougher in the Jan 24, 23 is a little bit better. And of course, it'll clean up as you get closer to expiration. So, we're looking at these right now when they're 5 and 6 days out, but when we would be trying to get out of them, which is when it becomes more important, we'll be closer to the money if we were right. And we'll be closer to expiration too. So it'll improve. Liquidity will improve as we get closer to expiration. So what we're talking about here, and you can pick your strikes any number of ways. I usually let price dictate which strikes I pick, right? It's not like we're going to go out and choose a particular delta and say, okay, well, we're going to put the trade on. We're going to use an 8 or a 10 or a 12 delta. Let price determine if you like the location that you're at, because these are binary trades. They're going to work or they're going to fail. There's not really going to be any kind of in between here. That's one of the drawbacks of using far out of the money options trades, right? There's you put on a trade like this, if you're wrong, there's really no salvaging it. All right, these are junk. So if you get below 4,200, you can see how the options are trash. There's nothing there. These are just trapped bag holders. I built one 25 points wide, and we're risking 20 cents. Price does not have to go all the way to my strikes, right? We don't need to see price go all the way to 41.50 before we see profit. All we need is price to begin moving in that direction fast. That's all we need. And that's kind of what we're focused on, right? We're in a wedge. The wedge is tightening. We're getting close to the apex. It's going to break one direction or another. That's not a maybe. It's a fact. It's going to break one way or the other. There's no way around this. The only question is it going to break hard, sharp, and fast? Or is it going to be more of this soggy, slow, grindy trash that we've been dealing with? If it's a hard, fast break to the upside, this trade will monetize. And what's your risk? If you're wrong, you're going to lose $20. It's a $20 bill, y'all. So that's one side. Do the same thing on the other side. And now your max risk is what, 40 something dollars. They can both lose. So don't think, oh, well, at least one of these are going to win. No, they can both lose. And this is a trade statistically that is going to lose more often than it wins. But dollar wise, it is a trade that would be more profitable at the end of the year than not, right? You will make more money doing this than you'll lose, even though you will lose more frequently than you would win. And again, I don't want a whole portfolio of these things, but time and a place. All right, so on the call side, it was really easy to see the bag holders and the trash. On the put side, it's a little more tricky. A lot of times I like to use mark because it just kind of helps see and identify what it is that we're looking for. We're looking for where does the values really quit changing. And it seems to be right around 37.90 and 37.95. That's when we start to really see the doubles, right? There's 2 6s, 2 55s, 2 50s, 3 45s, 340. See how they're doubling? That's letting you know that now, of course, the market's closed, but it's showing that there's no change in these. And remember, the SPX has 5-cent options. It doesn't have penny options. Once you're this far out, I like to look at the open interest. And when I can, I want to land on those. It doesn't mean I have to, but if I can pick one of those in my choice selection, then I want to when I can. So that's 10 cents wide, and it's kind of cheap. So let's go a little bigger. It's 15. And we're at 30 points wide. That's not too bad. So with that in mind, we're actually going to go to the roundy to the 3,800. That's going to increase the cost, I'm sure, but let's see it. Oh, yeah, we can do that. So there you go. More than 25 points wide. We're 35 points wide, still looking at $20. Not bad at all. One on each side. Max risk $40. You got 5 days to go. And if you could, I mean, I'm kind of close in here to the front. You don't have to be that close. You could walk it out to February. But if you do that, keep in mind, February 1, we have FOMC. We're going to want to put something together before FOMC, just for FOMC. So I don't really see the need to take this trade and extend it that far out. We would want something a little more fresh, right? Something more prescient to the market conditions as we get closer to Feb 1. Hopefully that makes sense. $10-day, 30-minute volume profile. We now have the point of control up at the top. Remember, yesterday it was down at the bottom. We've been across the top enough now that that's where the volume is at. Makes perfect sense. We do not have a defined profile, right? I've talked about this before. It not needs, but we're looking for classic shapes, a D or a P or a lowercase b. Those are the three most popular ones, but then we can also get a B shape. It's the shape of the profile, right? We don't have any of those. Instead, we've got a bunch of trash. It does have some shallow areas around 39.5, which is interesting because that's one of our pivotal levels. I'm surprised to see that it's shallow. But then we do have a lot of volume around 39.20, and that's not too much of a surprise. And then 38.20, closer to that 38.11 area, I think. But either way, no classic shape, no real assist here. All right, mapping out the 5x5. We still have that VPOC underneath us. Yesterday's point of control, we've already ran through it a couple times. There's no reason to carry it forward. We still have one overhead at 40.75. And that range that I was talking about, I mean, it really shows up here. Right? I mean, it's so clean and clear. Notice the volume from Tuesday. And kind of keep in mind this volume from Monday. We talked about that Sunday night, Monday. Really, we want to put all of this together as if it was one piece. So if we make a run towards yesterday's high, there's going to be a little bit of a fight with the volume. But old volume is not as significant as new orders, right? So when you're looking at the dome, trade imbalance within the dome itself is very likely going to affect you more than the volume profile and old volume. Don't forget that I mentioned expansion on each side, right? This looks like a raid, or it looks like a draw, and we're expecting a raid. One shot into liquidity and then a move. It doesn't owe us that, and it could be more of the strat style where we get that megaphone shape. So just because we break the range once and we begin to expand, and it's very likely going to come hard and fast because we'll land in that liquidity pool and it will cause fast movement immediately. We need to see it stick. And when we finally do begin to move, there's plenty of room to go. You see how close we are to the 10. So when we finally do break and begin going, there's plenty of room left. Don't feel like you're going to miss the ride. You don't have to jump in as soon as we break out through the range, especially if it's a downside breakout. We're above the 10 at this point. So if we break the range to the downside, we could get all the way back to the 10, and then we could go beyond the 10, 3% on the weekly before we would even consider that we're oversold and that we would need to back off a little bit. So if we start making a downside breakout, don't feel the need to just jump on immediately. Let that thing prove itself and give you some good, solid signals. All right, looking at the 10-day rather than the 10-week, we're still relatively close to the 10. I mentioned it yesterday, but it's worth repeating. Once we've kind of topped out, we're almost destined to go back to the 10 or to go back really close to the 10, right? You can see a few times we didn't make it all the way back before we tried again and tried again. But we've made a run up. We're expecting to get back relatively close to the 10 or all the way back to the 10 before making another move, another sweep. If we make another sweep, right? We might cross the 0 line. It's where we make a sweep up, then we make a sweep down. No matter which one of those two scenarios plays out, it still says we're going back to the 10 first. All right, we can see a little bit of this movement here in the dollar. And the US dollar Japan resetting the gap. Right, I know this doesn't look like a gap, but they made a decision. We had that huge spike, and then it spent the rest of the time unwinding that spike. More than once yesterday, we've seen the dollar have a topside breakout, a very clear topside pattern, beautiful breakout. And as the dollar was going up, so was the S&P. I pointed it out more than once. When I was pointing it out, it was before the breakout, obviously, because we want to catch it before it breaks out and get prepared for the trade, not after. And the preparation was, okay, looks like it's about to break out. If this breaks out, expect the S&P to go down, because that's what it's supposed to do. And that's not what we were seeing yesterday. So be careful right now with using the dollar as a proxy or as an indicator. Yeah, I think it was right around in here. Because we were looking for the dollar to break out of this level and make a move up, or to reject here and start to dump. And we had both of them moving in the same direction at the same time, more than once yesterday. So bigger picture, if you're not so tight on it and you're giving it a little more room, the bigger picture does play out. It's still going opposite, but if you get in closer and you're using a smaller time frame, the inverse relationship is not so immediate and not so fast. I think my answer yesterday, or my response, was one of these two are lying, and it's a fake breakout. But of course, we didn't know which one in that break yesterday until after it got rejected and came back in again. That is a huge, significant move. We're looking for the gap to get filled. Remember, this is still considered to be a gap. Now in US dollar Japan, it's already filled the gap, or very nearly has filled the gap. It's almost there. But in the S&P, it hasn't even come close. The way it's looking, we might not. Remember, it doesn't have to. It's just what we've seen happen more often than not. It made multiple attempts. So if we break the cog line and get below 40.10, that'll be our destination, 4,000, the roundy. All right, we're still looking for stability with nat gas. This morning was a little bit of a disappointment. We're below 11. I guess looking at it on the week, we shouldn't be too disappointed considering how it looked yesterday. And there is still a gap to fill. So when the market opens this morning, that gap will be filled. The 1176 gap was filled yesterday. Now we just need this one, which we're below it now, so it's filled, but it doesn't count until the bell rings. So we're going to be opening this morning down here. Look for some stability around 10.8. See if this base is going to continue to be built. Remember, we can overshoot a little bit. It's closing below 10.8 on the day that's going to matter. 10.76. So as long as we close above that, we're still going to be looking for this to base down here. Bitcoin's down just a little bit, which, it makes perfect sense after the moves we've been seeing. It's got to digest a little bit. Finance is basically flat. The rest of those are flat. Start getting into the positive side. Bonds are up. KWEB is up. But we need more out of emerging markets before we start considering KWeb and those China names as a viable play this morning. Energy's kind of squishy. It's not up enough to meet our qualifications. I finally got approved on TradingView for streaming. Not quite sure how I'm going to do that yet, but I've been waiting on it for months. So we'll see what comes out of that, but I think that might be something that gets added into the morning briefing. That'd be pretty cool. Maybe. All right, looking at the S&P, it doesn't offer us the S&P 100, so we got to use the filter. First, we set this to pre-market. Then we use the filter, change the settings, so we're looking at around 100 names by market cap. It's got a lot of gray, which is a good place to start because 0.5% is my line in the sand for anything that we would even want to focus on to begin with. And that's where the color starts to change. So it'll stay gray until it's moved at least 0.5% up or down. The monsters of tech stand out. Apple, Amazon, and Tesla, both up enough to meet the qualifications. Target and Disney. And some chip names got AMD. And then there's a lot of airline stuff this morning, which it's passenger airlines, not Boeing, but Boeing is up this morning too. So now we adjust the colors, make them a little more responsive, and the monsters of tech really stand out. Swap this over to the NASDAQ 100, pre-market change. No filter is needed because it's already 100 names. We just change the color scheme so it's more responsive. And again, the monsters of tech stand out. You should be able to instantly recognize them anyways. They are the bigger boxes, right? These boxes are a reflection of the market cap. So the bigger the box, the greater the market cap. One thing about doing this in the morning, like, what do we get out of it? Well, it means you can watch the NY FANG a little closer, right? So during the day, we watch KRE, regional banks. It's a more nuanced version of finance. And then we watch NY FANG. Now, we call it monsters of tech or we call it the FANGs, but in reality, it's not tech, right? It's just mega market cap names. And a lot of them happen to be tech. One of these two need to be doing good if we're going to get a topside breakout. When they work in sync together, then we start to get that rising tide lifts all boats kind of scenario, right? Where we don't have to focus too hard on being stock pickers because, you know, if 99 out of 100 names are all doing the same thing, anything you throw a dart at is going to be going up with the group or down with the group. But if they're working against each other, which is what we've seen a lot lately, one of these will be working in one direction and one will be working in the other direction. You need them to sync up for a really sharp move. Yesterday, some of the heads up that we had was the green line failing to stay with the group. It started to diverge right away, and that was a heads up. And then for a lot of the chop, the advanced decline or advancing minus decline really just wasn't expanding, right? In the S&P, it did later in the day, but in the NASDAQ, it really just kept trying to hold the range. I've got this little modified custom breadth. I was trying to duplicate an old school market breadth indicator that we can only get on TC 2000 trading platform. It's called T2104. It's cumulative volume. Having a hard time duplicating that. You can look for indicators, CTI or CVI, cumulative volume index, and you can find different versions of it, but it's not the same one, right? It's using advancing versus declining issues, but the volume of advancing and declining issues. So it's a little bit nuanced. You can Google it if you want to learn more about it. There's some papers on it. What stands out, though, even though my numbers don't match the TC numbers, the shape of this thing usually is enough, right? So if you look at the shape of the S&P yesterday, it just kind of topped out and wasn't getting anywhere. But in the NASDAQ, after a really strong morning, that kind of weakened a little bit, but it did still continue to advance all afternoon, right? So Friday and then Monday, well, Tuesday, right? Yesterday. So it was just a follow through from last week. A little leveling off, but still pointed in the right direction. So we're getting more of that divergence between the NASDAQ and the S&P. Generally speaking, that divergence is going to be the difference between financials and your big mega market cap names. And we have a steadily declining tick. The line you want to focus on here is the orange one. I know that's a mess and it's kind of hard to read, but it was just steadily trending down all day yesterday. From a short duration swing trade point of view, looking at that declining tick, understanding that we've topped out and we're very likely to begin moving back towards the 10. Put those two together, the short duration trade says down, back towards the 10. Another little heads up from yesterday worth noting is the weighted AD. Normally, this cyan line stays really close with those histogram bars, the yellow and the purple bars. They generally run pretty close together. If you look at yesterday, that thing was completely separate. So even though this thing is called a weighted AD and a weighted advanced decline, it's not looking at advanced decline at all, not even a little bit. It really needs a better name, but I didn't name it. I just got to call it what it is. So it's called the weighted AD, but this is looking at sectors, weighted sectors versus unweighted sectors. So the weights need to be changed every month. Those come from, you can go to like the XLF Spider website and you can get the weights for every one of the sectors that make up the S&P. And then you go into this indicator and you import those. the takeaway is that that cyan line staying away from those histogram bars was a really great heads up. It was one more thing to check yesterday to say, hey, stuff isn't doing what it's supposed to be doing. This doesn't look right. Doesn't mean we couldn't trade, just had to proceed with caution, and that we really likely weren't going to get anywhere. And that's exactly what we got. Nothing. The crossover signal was good from the topping and the move down. And then we had that wedge breakout, which it gave us the measured move, but that's all it gave us, right? It didn't give us any more than that. And we had the ticks yesterday doing a really good job, other than this small print right there. It was just maintaining really well between 500 and minus 500. It's a huge heads up that you're just going to get this rangy sideways day where we don't do anything, right? You need the ticks to press into the extremes, at least get down, to -8 or +8. When we don't do that and we're just staying between 5 and -5, you got to kind of have an expectation that breakouts aren't going to be real. They're not going to stick. We're just going to fall back down into them again or rise back up into the range. So at least this thing was one of the few tools yesterday that we had that was still behaving correctly. Take what we can get. All right, so keep your eye on the prize for today with the top side breakout. Remember that if we do break to the top side and we start to run, there's plenty of room to go up. You don't have to jump in just as soon as we break out. You could give it a little time. If we're talking about, a short-term swing to Friday or even next Friday's options. You could use 50% of the measured move from that big day we had on Friday, and that would put us at around 40.60. That would be the first of the measured moves, right? That's 50%. And then 100% of that move would be 40.93. If we break to the downside, we'll first just focus on getting back to zero. So we got to get through 39.95. Then we'll focus on 39.60. Then we can worry about measured moves to the downside. If you're on a platform that doesn't have really great drawing tools, just draw the line, move it over to where the breakout is expected to be. Cut that line in half. Just kind of eyeball it. There's your 50% and 100% of the measured move. Just keep in mind, if we break down this morning below 40.11, the cog line, it's just going to put us in the range that we've been already dealing with. We need to get below 39.60 if we're going to really expand and get beyond this trap that we're in. And that's not just for the S&P. It's going to be the same thing across high beta names. Anything that's moving like the S&P moves, if this is range bound, so is everything else. 8% of the NASDAQ is up 1% this morning. Not overly bullish. And 23% is up at least 0.5%. Those China names stand out: JD, PDD, and a couple of those EV names. Some chip names. And only 14% of the S&P is up 0.5%. So we're really ranged. It's kind of holding the line this morning. Continue to watch the dollar and the US dollar Japan. Yesterday, there were calls on the dollar to make it down below 100. That's going to be a big deal. Something to consider before we get off of here on the day is capital rotation. What we're looking at here in these two middle charts, I got 2 on the bottom, 2 in the middle, 2 on top. These 2 middle charts is Europe and Asia. We're looking at a daily time frame, and look at their run since November, where we kind of bottomed out in those markets. We ran back up towards that, for those names, the July high. It was July for them. It was August for us. It was November for them on the lows. It was November, well, it was October for us, right? So a little off on either side. When we look at the run back up in the S&P, we couldn't get past that August high. You look at the run up with them from July. They're getting really close to topping out there. If we start rotating back out of that market, where's it headed, right? Where's that money going to go? Look at Europe, the range that it had been in. This is the FTSE 100. Finally got out of this massive range that it had been working on for all of 2022. So, we got a breakout there on the year. Like Rosenblum talks about a lot, strength begets strength. And weak usually just gets weaker. On these top 2 charts, I've got the Dow versus the S&P, and the Dow looks just a whole lot better, right? It's sitting up near the top of that range. It's really close to getting a breakout. And that range top that I'm focused on is the August 10th high, right? But if you bring it over to the S&P and you look at the August 10 or that August high, we're nowhere near that thing. The Dow Jones has got 30 names. They're all blue chip, good, strong, healthy small list, 30 names. It's really worth looking at the names that are inside that, especially if you're looking for a market to kind of turn around from these lows, right? Because the analysts are saying we're going to range for the year, that we're going to get a massive capital rotation, that the big tech is done, and we're going to see a foundational shift in what's popular. Names in the Dow still look to be doing really good. So just something to consider if you're thinking about some bigger swing trades, longer term swing trades. The market's down a lot, which means everything's on sale, and trying to focus on, well, what do we want to own over the next year or two? There's a lot of names that are doing good. And as for, markets around the world, they're doing better than we are. So just something to consider, diversify a little bit. It's not all just Apple and Google and Microsoft and Tesla. We do have this really nice basing pattern in WTI or crude, Brent. With China reopening, we have a little bit of an expectation that we could see a rise in energy, especially fuel, oil, Brent. Everybody be careful. Have a good day. I'll see y'all tomorrow.